Hi everyone, hope you're all doing well. Today we have a special episode. It's our, I'd say, annual tradition to get the lads from the PlayingFTSE onto the YouTube channel. Steve D, Steve W, how are we doing?
Yeah, very well, thank you, mate. It's nice to be back again for another annual trip around annual trip around the world, around the sun, or whatever it is we do. It's been a pretty busy year for Steve and I. We've pretty much recorded every week bar one. We decided for the first time ever to have a break last week, so I don't think we're that refreshed, Steve. I don't know if I have particularly had much of a refreshing week off, but ready and raring to go. Had a decent start to the year as well in stocks. So, how about you, Steve? Are you feeling refreshed and ready to go?
No, it feels like the big start back, and it feels like it does at work, where you're basically trying to go from naught to full pace mode again. We did our prediction show as the most recent thing that we recorded, and that should be easier than most of them because you don't have to pay attention to that much news apart from stuff you've been thinking about kind of anyway. But it felt like a lot of effort to try and get that done. Being back in the rhythm will be nice, and it's really nice to be back here. Always enjoy this one every year.
I got to say, I always forget every year until it gets to this Christmas period about how much the stock market's actually shut. You think, yeah, it's shut a few days, and then I always realise over the Christmas period and this New Year period, I'm like, it's actually shut nearly every day, and I'm there looking, going, nothing's changing, nothing's moving, and I think it's good when we get a bit of normality back in the markets as well.
It's hard enough knowing what day it is, to be honest with you. Some of the days you think, well, why is it bloody shut? And you're looking because it's Saturday. That's the issue that I've been having. But to be honest with you, I could do with it being shut a bit more. I think between Christmas and New Year, it has no right to be open, really. I would rather it all be shut and we can just sit and crack on with, well, finishing off the turkey and eating all the chocolate and what have you.
Hey, not if that 24 hours a day stock market comes in that they were on about.
Yeah, it's too much that. I don't think we need that either. I think Steve and I have spoke about that. I think most people look at the stocks too much anyway, so adding extra time for it to actually be moving is probably a worse thing.
Yeah. So let's get on to our first topic, which we were going to talk about 2024, a bit of a recap, what our thoughts were on it. 2025, we've got any thoughts going on in 2025? I think it's probably important as well that we say if we're on about the UK market to the US markets, because I think there's a very different tone with them at the moment previously and what's coming up, I think. So 2024, Steve W., what expectations here? Surprised by a few things?
Looking back, it feels to me like it's very easy to think that basically whether or not you outperformed came down to whether or not you owned Nvidia. And that did really well. And it feels like everyone that owned Nvidia probably did very well, and everyone who didn't probably fell short of the index. And it's quite natural and quite easy, I think, to fall into that. And I view that as a trap looking backwards. Steve and I have been talking a fair bit on our show that actually you could have owned Nvidia and pretty well underperformed. The US tech sector underperformed the S&P 500. It has Nvidia in it, it has Palantir in it, it has Broadcom in it. All three of those were excellent. Also had a lot of stuff that was really terrible as well. There's an awful lot of, broadly speaking, semiconductor manufacturing stuff that kind of wildly underperformed. And one of the things I sort of take away from this is a few bad things can really drag a decent portfolio, an otherwise decent portfolio. That was kind of the case with my ISA. My top end all did very, very well. A couple of negative things, and suddenly it's hard to get past 22.5% overall if you've got a couple of things that went literally backwards, like in my case. Diageo is a good example of a thing that I own and was down quite significantly. And if you are towing that kind of negative weight as well, and you're trying to get to 20-something percent, 23% to get ahead of the S&P 500, life is hard. But it's a fair point that mostly growth came from the Mag 7, most of which are outside of the S&P 500's tech sector, which is why the tech sector faltered a little bit, even though we tend to think of Amazon as tech and Meta as tech and Alphabet as tech, and none of them are strictly in the tech ETF. But it felt to me like it's not wildly simplistic to say it was a Mag 7 year for the US, but I do think I'm a little bit wary of the idea that I've heard being kicked around that says if you owned Nvidia, you outperformed, and if you didn't own Nvidia, you didn't.
Yeah, I think that you're pretty close to my thoughts there. I think that there's certain stocks that went on very extended runs. Metric expansion, I think, was a key thing. I thought the market were going to have a a decent year, but what I didn't realize is that we were going to see the S&P go to like 29 times earnings. I didn't expect the likes of Costco to go to whatever that was, 53 times earnings now. I think it's gone up to. I think that is one of the big catalysts that I didn't see happening that has happened, and I guess can always happen. I guess what I was saying on an actual YouTube video that I did the other day is that I was saying that, to be fair, if you don't, or if you're an individual stock picker and you don't own the big tech, I've seen a few people saying, "Oh, well, I've only got 30%," but at the same time, you didn't own any of the Apples or the Nvidias. That's actually not a bad return. I think a few people are kicking themselves because they haven't got these stocks in the portfolio. But what I think some of these stocks did this year isn't sustainable and won't happen every year, and that's something just to be aware of, really. Steve D, anything you want to add in there?
Yeah, only that the chat that Steve was talking about was something Paul posted, and it was basically just saying that since this most recent bull market began, if you were to strip Nvidia out of the S&P 500's returns, it's not actually beating the European stock market return. It's that's how much of a push Nvidia has added to the S&P 500. So it has been a monumental push because it's gone from a few $100 billion to a few trillion in market cap. So it's been a huge push along, but it has been one of the least number of S&P 500 companies that have actually beaten the market, that have pushed it along, and some of that's to do with the concentration of the big companies at the top, but some of it is to just do with the fact that a lot of companies didn't perform that great last year, and Steve was right to highlight that. I mean, if you were sat down without knowing, and Steve said, did the tech sector outperform or underperform? Of course you were going to say, yeah, of course it outperformed last year, because that just, it makes no sense that it didn't. But it was about 3 percentage points below by the close as well, so it's quite a significant difference. But it's a big hurdle to get over. Is 24% when you're thinking about your portfolio and market returns. If you said, I got a 15% return last year, whatever it was, you'd be saying, yeah, I'm pretty certain I beat the market with that. No, not last year, and not the year before as well. So we've had 2 monster years in terms of returns, both of them between 20 and 25%. And that just makes you think, looking forward, can that happen again? If it happens again, it'll be very, very rare. So when Steve and I were thinking about our predictions that go out on Sunday, we were trying to bear that in mind with what we were predicting. Can it go up another 20%? Well, all the conditions seem like they're going to be there from the Trump administration. It looks like it's going to be a low tax administration. It looks like they're going to try and cut red tape. All these things businesses absolutely love. It's going to be a pro-business administration, but that unfortunately doesn't mean that stocks are going to excel again. Maybe they're excelling in anticipation of it, and maybe we're in for a fairly flat year or so whilst earnings catch up, because like you said, things like Costco, they've got no right to be trading at 53 times earnings. This isn't a company that's hiding half of its earnings somewhere down the back of the drawers that you can have a look through the financials and say, look, here's the real earnings when I add these back in. Costco doesn't have anything like that it's hiding. So it's a steady eddy. It's been a very good performer, but that doesn't mean to say it should be trading at 50 odd times earnings. So I think this year that we're going into, 2025, is going to be a year of the stock picker. I actually don't believe last year was a year of the stock picker. I think it was pretty much an indexy kind of year. But I think we're going to go into tougher times, and when times get a bit tougher, that's usually when a good stock picker starts to shine.
Yeah, I think you're right with what you were saying there. I think when you look into 2025, I wouldn't like to bet against momentum. You never know momentum, when that momentum will stop. Example, Palantir. I saw Palantir go up to 50, and I was like, maybe that's it now for Palantir. Then it went to 60, 70. I think it's even 80 now. And every time it's been going up like an extra $10 gone, that's enough for it now. And it keeps going it. So, momentum is something I won't bet against. I think at some point, though, as the elastic band gets more and more stretched, I think there's always a point where it has to snap, and then the more that it's stretched, as 2021 and 2022 showed, the more it stretches, the bigger the pullback when it needs to get back to its realistic valuations, which is the absolute stinger when that does happen in the market. Obviously, that was kind of a bit of a US kind of based kind of commentary. UK, little bit different, I would say. In my opinion, from what I saw in my portfolio through 2024, is that the market started okay for me. Back end of the year, a little bit of a dive down. I think concerns around the budget, the NI impacts, maybe because I'm a little bit more retailer based in the UK, that maybe hit me a little bit more than maybe you two with your portfolio mix. Looking into 2025 on the UK side, I think the first few months might be a little bit nervous around how these companies are going to pass on these costs. Is the inflation going to stay okay with these prices going up? And then maybe to the back end of the market, maybe the UK picks up in 2025. I think what you were saying about that individual stock picking market, I think that's key probably for the UK markets as well, especially when you look at the FTSE 100 and FTSE 250. There were still a few stocks in the UK markets that did quite well last year. One of mine was Supreme, that had a cracking year last year. Darktrace was one that did quite well for me, and the reason why is because of acquisitions. I think that while it is muted on the returns, potentially on the UK side of it, I think a few companies are looking to take advantage of it. A few US companies are looking at some of these UK stocks going, good exchange rate at the moment. It's easy for us to get capital. Some of these UK companies are trading very cheap. They've got a good exposure to the US markets. If we're going to buy this company in the US, it would be a lot more of a multiple metric than what we would currently pick it up for in the UK markets. And if anything, I think the motivation for UK investing is maybe as well, I think we spoke about it before we start, is takeovers. I think there's a lot of potential for takeovers in the UK market as well, with some of the valuations that are here at the moment. So, Steve D, do you want to kind of start off maybe with what's your thoughts around 2024 in UK markets, 2025 UK markets?
So 2024 was a slow year for the FTSE in terms of performance. There was a lot of takeovers. A lot of really good companies went to pretty much American or private equity companies for decent premiums as well. So there was stocks that Steve and I spoke quite a lot about, and things like Keyword Studios as well that had a large fall. Looked like a really good company, came to a valuation that people started to think was palatable, and then got taken out for, I think it was a 25% premium as or something along those kind of lines. So I think that's really, I still think that's kind of sad, and we've touched upon this on a show that's going out on Sunday. Eventually, this money has to leave these money market funds. Last year, I was telling everybody who would listen that there's about $6 trillion in money market funds, and as the rates come down, it's not going to stay there. I thought rates would come down fast enough this year that we've just had so that they would leave, but actually that's grown about 16%. That the money in that money market funds, it's now getting on for 7 trillion, and nearly 2.5 trillion of that is retail funds, and the rest of it institutional. So that money has to go somewhere, and it's going to happen at a time when US equities are pretty expensive, and there's a lot of people out there, your Goldman Sachs, your Vanguards, who are saying, look, these prices are too high. Your expected returns on your S&P moving forward are not 20, they're not 10, they're not 8, it's more like 4, 3 or 4. And that's probably not going to be enough for a lot of people to want to move from a money market fund paying 3 guaranteed to 3 or 4 maybe. But what might entice them is going abroad. So maybe looking at the EU markets, maybe looking at emerging markets, maybe looking at the UK markets, because what you're seeing here is essentially a load of English UK companies being taken out for 30, 40, 50% premiums. Now, if you just budge those share prices along 10 or 15%, moving a hell of a lot of money market money into it, they can still get taken out at 20 or 30% premiums, and everybody makes a killing. Now, I think that's more attractive from a risk-reward perspective from people who, let's face it, are risk-averse. They're sat in money market funds on a moderate rate system as the markets climb 20%. So it's going to be interesting to see what happens on that front. I think that money. This is probably the last year, depending on where rates go. Probably the last year that we're going to see, growth in the money market funds, amount of money held in them. So it'll be interesting to see what happens. And I wouldn't be surprised if it starts flooding down into the UK market. One of my predictions as a spoiler for Sunday is I actually think the FTSE 350 will beat the S&P this year in terms of returns, and mainly because I think the S&P is due a flat year to try and have earnings catch up a little bit. And I think the FTSE 350 can have a decent, moderate 5, 6, 7, 8% kind of year. That should resoundingly beat the S&P. But we'll see on that. Steve and I don't have an amazing track record of predictions. We normally get one right out of 6, sometimes 2. Sometimes we give ourselves half points to try and make it better. But we'll see. I just can't see another 20% year from the S&P, so I'll be intrigued to see what happens next year.
I've not looked at my predictions yet from last year to see how I've done, but every year I keep sticking on S4 Capital have a good year, and I don't know how I keep putting it on my
I go short
predictions.
Tesla.
Yeah, Tesla short. I think that one was on mine this year, and that's I spent a good 8 months going, yeah, I've got this one right, and then it got to about September time, and I went, I didn't say that. Steve W, anything you want to add in?
The more I think about UK markets, the more I think about them as a stock picking environment. I don't have massively strong views about kind of UK macro. I do have sort of fairly much more carefully thought out, as far as I carefully think out anything, I guess, views on individual stocks. To go back a year ago and looking at what was cheap and what looked promising, it turns out the 4 things that were going to do pretty well for the FTSE 100, barring takeovers for the moment, leave those aside, were Rolls-Royce, Barclays, IAG, and NatWest. And 3 of those don't surprise me. The one that surprised me is British Airways. Basically, I didn't see that coming. I thought this was going to be a bad year for them. But NatWest and Barclays, both the beneficiaries of higher interest rates in the year before, clearly piling up cash, going to launch a massive share buyback scheme. They pretty much both announced this in February. It didn't surprise me in the slightest to see those going higher. Looking ahead to 2025, I know myself in this situation, and I am notorious for calling the top of these things early. And I'm minded towards thinking they won't do that well again next year. That was interest rates are coming down. Catalyst has blown itself out now. The buybacks are known. Dividends are known. Various restructurings going on at Barclays are in the public domain. That'll be that, right? But it wouldn't surprise me to learn that I'm calling this one far too early, looking ahead next time. Rolls-Royce at the start of the year, it went up about 100% in 2023. And we recorded a show about this time last year. Today is the 3rd, by the way, for anyone that's interested in what I'm talking about there, where I said, actually, I think this still looks like decent value and I think this could still go. And for once I was right about something there, not an official prediction, but this did have longer to run. I'm now less clear that I think it has that far to go. And British Airways annoyingly, it looks set to do well again next year. Oil prices, I don't have a particularly positive view on those, and they are big fuel consumers. Lower jet fuel prices should benefit them. Where I look at the things that have done well, they are mostly individual things that have been coiled springs for some reason, rather than any kind of structural, here's what's going on in the UK type of thing, with the exception of maybe interest rates. But Steve says it's going to be a year for good stock pickers, so I suppose I should probably index.
Yeah, it's funny, airlines. I've had Jet2 for quite a few years in my portfolio now, and when we came out in 2021, I thought, yeah, everyone's going on holidays. I understand the boom. 2022, that was a year where it had another good year. Thought, oh, everyone's still on holidays. 2023, same again. And last year was where I got to the point where I nearly sold Jet2 in 2024. And I thought, that's it. Everyone's kind of out of the boom of the holidays now. But they've had a fantastic year. And I think a few other ones. I think On the Beach has been a stock that's had a very good year this year as well in the UK markets. You know, people say you can't get returns. I think go look at On the Beach. They've had an absolute exceptional year. Going on to some individual stocks now. I think I sent a message across to you guys, picking a UK stock to talk about each, something that maybe we like that stock, maybe we're unsure on that stock, maybe it's something you're thinking about selling, whatever your point is around that stock. And we've all got one each to talk about. Steve W, do you want to go first this time and talk about the one stock that you've picked to mention from the
Sure.
UK market?
Okay, I was trying to work out what kind of stock from the UK market I thought your audience might appreciate based on some of the stuff that I know you own and discuss and like to think about. So here's a stock I'd mentioned on our show, JD Wetherspoon. Then you know what that is and what that does. They're a FTSE 250 pub chain. Over the last 12 months, that stock is down 25%. What's going on? What's going on with the business is sales are up 5%.
Steve
Like for
W, can
like
I just say
sales.
something really quickly?
Go
Sorry
on.
to interrupt. I think I remember you mentioned this on your podcast, and the guy to the left of you on my screen right now from Hull said he hasn't been to a Wetherspoons in like the last 4 years. I cannot believe what I heard when that was said on your podcast a couple of weeks ago. Sorry, I just had to say it there because
I have been in a Wetherspoons now, Steve. When I was on jury duty, it was across the road from where I was on jury duty. So I popped my head in and had the beer and a sandwich deal for like ridiculous. So it's like £4.37 or something stupid like that. And yeah, it's shit.
sorry, Steve W.
You should hear what he said about Card Factory. Now, their
We're gonna
sales
have
are up
words about that one.
5%. Sales are up 5% over the last year. Like-for-like sales are up 7.6% because they've closed 25 of their pubs. Earnings per share as a result of bringing down their costs by shuttering things are up 70. I've written 77%, but the number I have in mind is 74. I'll check that before this goes out. They brought back their dividend and they're busy buying back shares, 40 million or so, which is about 5%. So business moving in the right direction, stock going in the wrong direction. Why? Several reasons. One is an increased cost of living, although that doesn't seem to be worrying people. They seem to still generate higher sales. But the bigger issues are questions around inflation and the budget, which I know is a thing you've had a couple of videos about so far. So higher national minimum wage, higher national insurance. This is going to raise costs for the hospitality sector broadly, and the big question is, what is anyone going to do about it? And it might seem like it's worse for your Wetherspoons of this world, who are supposed to be low cost, low price operators. Raising prices for them destroys their kind of competitive position, right? I think this is a mistake. So shortly after the budget, Tim Martin, who's the chairman of this fine organisation and personal friend of Steve D, said it was going to cost around 60 million per year in increased costs. And understandably, the market had a fit about this because 60 million is what Spoons makes in a good year. It's only had 1 year, and that was 2019. It's in the last 10 where it's made more than that in profits. So realistically, prices are going up. But three big buts for you. Number one, everyone else across this sector appears to be pushing prices up as well. And being the lowest priced operator here doesn't involve keeping your prices steady. It involves keeping them lower than everyone else. Fuller's have already said prices are going up. Young's have said prices are going up. Wetherspoons has room to raise them while still being cheaper than everybody else. Two, they're already well below. Actually, they've had room to raise their prices without running into competitive territory for a little while. Way back when, in the kind of COVID pandemic, they cut fat on hospitality, basically, to try and help this kind of sector out after it had a tough time. Everybody else past that basically kept the difference for profits. Spoons passed it through by cutting their prices, so they're already about 30% lower than most of their competitors. And if they were 15% lower, their profits would roughly double. The third thing, and I guess probably the biggest worry I'd have here, and worry is probably too strong because I'm reasonably optimistic, is if you put your prices up, will people stop coming? I guess is the big question. And I think one thing I wonder whether people are properly appreciating here is that their big price increases are going up because minimum wage is going up, i.e. people are going to have more money, and the kind of people who go to a Wetherspoons are going to have more money. I think this is kind of unusual for low-cost operators. So if you think about someone like Ryanair, I have a strong sense that most of their customers hate them but go there because it's cheap, basically. And ultimately money talks in this situation. I don't get that impression with Wetherspoons. I think actually most of their customers quite like it there, and they are pretty much loyalists and like the organisation and the atmosphere and like being there. This is entirely anathema to the person sat across from me, whichever side he is on at the moment. But I think they have a loyal and committed customer base who will go there if they can. And I think they probably will. So I think the long-term outlook for this company, in terms of pricing power, which is a weird thing to say for a low price operator, pricing power. But pricing power doesn't necessarily mean ability to charge more than your competitors. What it means is the ability to raise your prices without losing your market share. And I think Wetherspoons might have that because it's already so far below its competitors that it's got scope to raise them. So I think this is interesting. I mean, it's wildly out of favour with the stock market, and it's fair to say I was early on this. But when I look at the underlying business, sales per pub have never been higher, and I don't see this as being in a particularly bad situation. I'd rather they got on with buying things back rather than reinstating their dividend, which they did earlier this year, and I wasn't thrilled about. But to my mind, I think the market's overreacting a bit here.
It's one of the things that's really interesting to me is that basically the investors are saying, "Whoa, Wetherspoons, you've got a big hefty bill coming up with all these national insurance and minimum wage increases. Whoa, we'll better send you down a little bit to counter that." But what they're kind of missing is that everybody's in the same boat. There's quite literally a piece of insider information going around every retail outfit, whatever pub in the country of any kind of size that's saying everybody's bills are going up, and they're all going up by roughly the same amount, per employee, roughly. There's a 20% price increase probably needed across the board everywhere. And you've got carte blanche to raise your prices here because you know that nobody in the industry, especially in the pub industry, can afford to swallow this level of increases. As Steve said, 60 million in a good year, 60 million of costs. That wipes out everything that Spoons makes. That's going to be the same across everybody. Nobody is operating on 20 or pubs on 20 or 30% margins. They just don't exist. So just raise your prices. That's basically how businesses are going to get around this kind of scenario. You're not going to make yourself uncompetitive because everyone's in the same boat. Everybody is going to have to raise their prices by a very similar amount to maintain their margins. So it's one of those things that I think is like a paper-made fallacy, in that people have read it in the newspaper and gone, well, this is going to take tons and tons of businesses out of operation. And it's just not the case. All that it's going to do is mean that the consumer pays more for things, in the same way that when Trump wants to put 100% tariffs on something, well, if you don't produce it in the US, guess what? You're just going to have to pay more for it. And that's all that's going to happen. I would expect to see a pretty hefty spike in inflation across most industries next year, just while with this extra cost works its way through. Because anybody, and we've had this conversation at work ourselves, anybody who tries to swallow this increase when everybody is facing the same increase is a mug. They should just pass the cost on, because that's the only really way to get around it. Anybody who swallows it up is just destroying their own business.
Very interesting point, I've got to say, Steve W, on the big increase of minimum wage and Wetherspoon's target audience. I never actually really thought that actually they could be good when you look at the audience of who would go to Wetherspoons. Clearly not Steve D. The audience that go there are going to be quite big benefit. Going to benefit in April from some of the minimum wage changes, for example. Maybe they go order one of those extra baby Guinnesses or something. Potentially that could work out for them. What I know you owned a position. Are you currently still adding in currently, Steve W, then at the moment?
Ish, yeah. I mean, it's on my list of a few things that I'm currently interested in buying. It's a major reason that I underperformed slightly last year with that kind of stuff going the other way. But I can safely say I'd be happy buying it at these levels. I mean, in the case of, they come down to, I like companies that sell things for less than other companies because they have lower cost structures. And Spoons does have a lower cost structure than its competitors, and that makes me kind of happy buying it here. Probably fair to say I didn't do my valuation work carefully enough a year ago, and I was guessing a little bit about what free cash flow might look like. At these levels, though, I'm a buyer as and when I got cash to do it, and as and when I can kind of balance my portfolio appropriately with it.
Cool. Steve D, over to you.
So I've gone for My first company being pretty much one of the, I think it's the biggest company on the AIM. I've got that in my brain. I'm not sure if it still is. I know it was for a period of time, but we'll roll with that for now. And it's Judges Scientific. So they're a specialist in scientific instrumentation. They don't actually make the instruments themselves. They buy companies that are already successful in making these instruments, and this gives them a whole catalogue of different products for labs and research facilities. And the more that they buy up, the more that they can offer the customers. It's a smart way of growing. It makes the products sticky, and every time they add to that instrumentation, the products become more and more sticky, because for these kind of companies that buy from them, it's almost like receiving the Argos catalogue of implements that are good. The thing that gets Judges Scientific the most sort of interest from investors is that they've been really, really good at making smart acquisitions. They buy companies that make good money, and then they make their companies even better, even more profitable. They've got a really enviable track record, and that makes investors think that essentially Judges Scientific can just keep growing as it continues to do that. It's not a massive company. It's about half a billion, in terms of market cap. So you think these little 20 and 30 £1 million acquisitions that the likes of Berkshire can't look at, they're very, very much in Judges Scientific's wheelhouse. So their share price took a pretty big hit last year, and it was mainly because they lowered their earnings expectations a couple of times. They had some problems with delays. A couple of the projects got pushed back. A couple of their acquisitions didn't get over the line as quickly as they thought they would, and that news actually spooked investors quite a bit, sent it down quite a chunk, really. But I think things are looking a bit more positive for them moving forward. They've got new acquisitions in the pipeline. Operations are definitely back on track. They've got this solid history of making smart decisions, making smart acquisitions. So I think there's real reason to be optimistic about their future. So Steve and I call these kind of companies roll-up companies. We've talked a lot about Bonzo, and we've talked a lot about a company we really admire called Diploma. We think it's probably one of the best companies in the FTSE 100. And this is another one, just to add to our list of the UK roll-up company, something we are really, really good at. Companies that buy small companies, integrate them under this big umbrella, make them better. They're like collecting toys and putting them inside of a giant toy box. And I think Judges Scientific is probably the next good one that we've got coming along. And I put it there with Ashted Technology, which is doing something very similar in a different space. But I think we've got two roll-up companies there that are quite exciting for the FTSE market.
There's a category of investor that's going to look at Judges Scientific, Google it, and see a price-earnings ratio of about 46 and think, no, basically. And that's fine. Anyone's entitled to think no for whatever reason they want. They'll then look at it and see a forward price-earnings ratio of about 23 and think that doesn't make any sense, to be honest. What's going to happen here? Is it the case that earnings are somehow going to double in a year? And the answer might be yes, because of what Steve was talking about with regard to delays. So this year's earnings are unusually low because stuff has been pushed into next year. That will make next year's earnings probably unusually slightly high. So 23 might be a slightly artificially low multiple here. But I would put this way, absolutely no one has to buy anything that we talk about here, and we're certainly not giving any advice on this. But one thing I would say is when you have a look at this, if you do have a look at this, have a good look at what's going on with those earnings being slightly choppy and distorting that multiple. You can still think it's overvalued after you've done that, if you like, but I wouldn't dismiss this just on the basis of it has a high backwards PE here. There are short-term things going on that are making that quite a wobbly metric to use for this.
Yeah, and it's also important to note that when they're buying companies, they're pretty often buying them from earnings, cash. Sometimes there's a little bit of debt involved as well. But when they're buying companies like this, that is actually suppressing their earnings because they do it so often We're talking sometimes 2 to 3 companies a quarter can get rolled up into these companies, and they're not massive outfits. So even if they're buying for £1, £2, £3 million, that can make a massive difference to their earnings over the year. So that's not earnings that are lost. Remember, that's earnings that's already been reinvested into growing the business over the following years. So if you're looking at a company like a roll-up company, Steve and I are of the opinion that you should add those acquisition costs back in to give yourself a true earnings number, and that just gives you a second opinion essentially of where these companies currently trade, because they look expensive, but when you start to factor everything back in, they tend to look a lot less expensive really quickly. And Judges Scientific is just another one of these companies. It's a really interesting company. We're lucky to have it on our shores, and it's been a pretty big winner over the last few years, and it looks like if they can continue to find companies to buy, which at their size shouldn't be too difficult, that should continue.
Yeah, I was going to say what Steve W actually just said. I was looking at some of the forecast actually when you were just speaking there, and yeah, some form of dip which you summed up to be acquisition related, and some projects maybe pushing a little bit later on into the year. But yeah, if you look at the moment, you might go a little bit expensive. But if you look at some of the broker forecasts at the moment, 2025, 19 million in profit, up from 12.9. 2026 has got 24 million forecast on it. I mean, very quickly, if you start scaling up that profitability at some them former levels, it's something that might look a little expensive now, but if you blink and you look back in a year or 2 years' time, it might look relatively very cheap. So yeah, I've not actually really looked into it too much. So good suggestion. I might have a look at that one a little bit further. One from me.
It's just gone, but before we do, it's an 83x over the last 2
Wow.
decades. So it's a company that has it's gone from essentially being around a pound a share to £86 a share. So that kind of gives you an idea of the growth that you've had there.
That's pretty impressive, that. One from me. I'll keep it a little bit brief because I know my audience probably hear me talk about it once a month, at least on the YouTube channel. But mine's a UK stock called Gaming Card Factory. Sorry, Gaming Realms. Don't know if you guys have heard of this one. They're a B2B developer, licensor, iGaming provider. So they go to the likes of Paddy Power and provide games for them. The one that's mostly known is the Slingo game, which is like a noughts and crosses kind of iGaming game, and they kind of pair that up with some like deal or no deal. They only went up 1% in 2024, despite in the H1 results, revenue being up 18%, profit before tax being up 51%. Currently trades at a forward P of 9 times earnings. Clean balance sheet, pretty decent cash balance. I think they've got about 10 million cash balance to about 100 million market cap. This year, they're forecast to make about 10 million in profitability, which obviously is a pretty decent cash balance that's going to go onto that bottom line. They also have only 78 workers, employees. That means that from one of the concerns I have next year for UK stocks is the big increase of NI, minimum wage. It's going to be a stock that more than likely isn't going to be majorly affected by that and avoid the NI. And as I have quite a few investments already into like the US iGaming market, I think that this is a company that has big tailwinds in the next few years with the states that are coming online, the iGaming states that are coming online in the US, and it should do very well with some of its clients that it has over there.
So I have absolutely no idea what this even means. The word Slingo is something I've just been Googling now just to try and figure out what it is. But you go down this list of companies and you can see that their content's on pretty much the big set of at the top of the betting sphere. You've got BetMGM, DraftKings, Entain, and Flutter. They're the big boys, and Gaming Realms has products that are on those four. You couldn't ask for anything else. Really, when you're thinking about that, they're live in America, South America, and Europe. They look an interesting company. I got bent with Entain, and it really put me off the betting market in that I thought it was fairly straightforward to understand, and then they started doing illegal things and getting fined left, right, and centre. And that really, really put me off because it just felt like it was a market I could never fully get my head around it. I think there's huge amounts of regulatory risk going on there. But like I said, this is a market that you've done relatively well in, especially with your DraftKings buy and what have you. So I would say, potentially this is one where you trust your judgment on it, and I think it's one that I would stay clear of, though, because of my previous burning with Entain.
I've not been burnt with Entain before now, and I'm not averse to this sector either. I think I've seen you talk about this before, Jacob, with Gaming Realms. I'm pretty sure that's the only place I've heard of it, actually, to be honest, to this point. It's on my list to have a look at, because I think it does look kind of interesting here, and I'm interested in some of the things that, in a few different cases, the things that kind of power games here rather than the kind of front end of them and behind the scenes. It's growing quite nicely, and it's growing by expanding quite nicely. And over the last, go back sort of 18 months rather than 12, just for the moment, and it's been making its way into new markets and doing a good job of kind of geographic expansion here. I guess there comes a point eventually where you cover enough of the globe that your main markets you're now fairly well set in, and at that point growth starts to slow down. But if you're looking at sort of 9 times forward earnings and not much going on in terms of on the liability side of the balance sheet, that's got to be an interesting. You view this as growth or value as a stock? I know that's not a very good distinction here, but I mean, is your thought that this is just underpriced and going to re-rate, or going to push higher with earnings as the next year kind of comes ahead?
I think it's an unusual one because it actually offers growth and value. I think when you look at the growth potential, there's clear growth drivers for many years, but you're getting growth at a value play. Talking about a company growing at 15 to 20% at 9 times earnings is, even look at maybe some risks with the area that they operate in. I think is not many growth stocks trade at valuations.
It's absolutely smashed the market over the last 5 years as well. When you look at that, it's up about 3 times what the market return is. So, yeah, it's had a flat period, I suppose. So you could have technically realised almost all of that gain a year after it happened. It's down about 18% since then, but it's up 254% over the last 5 years. You can't really complain about it. When you swap it onto Max, something weird happens, and it tells you that the price used to be nearly 68 quid a share, which is potentially interesting. I'm now really intrigued. Need to find out why that happened. So I've just bookmarked that to have a look at it and see why. But yeah, really interesting to see. It was once it's been on the market a long time. It was a pretty high flyer with a pretty high share price, and then it kind of flatlined back in what looks like 2012. So it'd be really interesting to see what happened from that period of time. It's been, since 2012 to today, it's still down 70%. So yeah, really interesting. I one that I'll definitely like to have a look at a little bit more. I don't know whether you know what happened back then, or
I was just going to say, I think you're picking up an old price that used to be back quite a few years ago, 2011 or something. I think that's when it were there. It just had I can't remember now, but it had I did look into it. It was something to do with just a change in business model where they went from, I think they were like an offline based, maybe in the casinos, putting machines in the casino. And then I think it was 2019, 2018 or something. And then it switched to the Slingo and the iGaming because they realized that was the big growth driver. So there was a switch of business model, I think, somewhere down the line. I just can't tell you the exact dates off the top of my head.
fair enough. What's next?
I'll just add in there as well. I think what I'm going to say as well is that I think that if it just stays here for another year, I don't know how long some other players in this space will be staring and going, hold on, we can get a company for 100 million that is growing 20% a year, that throwing off 9 times earnings before they go, hold on, if we put 100% premium on this, the gaming realm shareholder is going to take that, and then we get a company that's growing at good rates, cheap. I think this is, as we were saying earlier, is come to the point where I think it's one of those that will be on the UK takeover target list. I think
Is this what Evolution would buy? So
there you
exactly
go.
that.
Yeah, exactly. So going on to a US stock that once again we're interested in for some reason, where we like it, turnaround play. Should we start with Steve D this time?
Well, I cheated and I actually picked a German stock just because Steve and I have recently put together a Eurobox, and I found so many stocks there that I really, really admired. And This one is one that Steve and I have spoken about quite recently. I think we spoke about it when we first started doing the podcast, like 4 years ago, something like that, 3 years ago, whenever we started it. And then a long period of time where we didn't talk about it, and it's come right back on the radar. And it's a company called Sartorius. The ticker is it's a preferred share on Trading 212, SRT3, or you can buy Sartorius Stedham, which is the biotechnology arm of Sartorius. I think that's on the French exchange. I'm not entirely sure what the ticker is for that, but it's a big name in Germany in science and medicine. They make all sorts of things for labs and for factories, machines that weigh things accurately, filters for purifying things, and they do whole systems for making important medicines like drugs and vaccines. They basically make sure science and medicine that we rely on to keep us alive is both accurate and safe. The speciality is essentially lab fit out, kitting out factories and labs with complex machines. They make really high tech tools and systems that can separate out even as accurate as things from the good parts of a medicine from the bad parts of a reaction. They make sure that there's a right amount of everything in the mix, and they can also make keep things sterile so that the medicine is safe to use. The business model is like a razor and blade style model. By that I mean when you're thinking about buying, your new razor, you buy the razor, you keep that for a long time, but it's the blades that you keep buying to make it work, and that's essentially how Sartorius's businesses work. They sell the big machines and systems for the factories, but they also sell all the things that keep the machines running. Specialty chemicals, filters, software updates. So they make money on the initial sale, and then they get ongoing income from all the smaller bits and pieces, the consumables, to keep the machine running. They've got some absolutely huge customers, just their top 9 or so customers. GlaxoSmithKline, Samsung, Lonza, which is another company Steve and I spoke about a lot, Sanofi, Roche, Pfizer, Amgen, Regeneron, companies of that kind of ilk. It was a big COVID story. Huge lab fit outs, large amount of over ordering to make sure that these labs had everything they needed to make the vaccines. Unfortunately for Sartorius, that's where the good news ended. Vaccines pretty much dropped off the radar, and it's taken Sartorius's customers longer than expected to destock. But we're pretty much through that now. We're back to a level of normality. So it's now really up for Sartorius to start executing. So I had a look on Morningstar. Morningstar has Sartorius AG and its bioprocessing subsidiary that I spoke about earlier, Sartorius Stedham, as companies with a very wide moat. It has a fair value on there of about €265, so about 25% upside from where we are today. I'm actually a little bit lower than that, but only a little bit, €263, and that was presuming around 12.5% annual free cash flow growth when we normalise it back to sort of just before pre-COVID times when I was taking it, because COVID felt a little bit high. So yeah, this is a company that I really, really like. I think it's a pretty big player in the European market. I've added it to my portfolio in the last couple of months, and it's a position that I'm looking to grow out this year when I can get some new money into the portfolio.
We've talked a decent bit on our show about Steve D's exposure to healthcare and the complicated nature of vaccine companies in some cases. And it's very tempting to get stuck on the thought that you have to try and read into what's going on with some pharmaceutical company's pipeline and try and gauge the success of that better than a bunch of analysts who are pretty well trained in a lot of cases for this sort of thing to make meaningful progress in this area. But this is a good example that says maybe that's not quite right. I mean, when I think about healthcare, and I said this on our show before, you can either be very specific and target particular companies that you think have better prospects than their market caps currently reflect. And sometimes that can be easy and obvious, but it has to be very easy and obvious for it to work for me. Or you can be very, very, very broad and buy something like a lab-based REIT. But the downside to that is growth is going to be quite limited. Even if the sector does explode, you're only going to get your rent paid. People don't overpay on their rent just because they're making more money. Sartorius is somewhere nicely in the middle of that, as I kind of see it. It is exposed to growth in this sector. We've seen GLP-1s taking off to a fairly strong extent. I think the exact outcome for that is probably still a bit unclear. And Sartorius stands to benefit from the more they grow and the more they develop, the more Sartorius will make, without being a specific bet on, say, Eli Lilly over Novo, which it would take a big price swing one way or another for, I think, it to convince either of us that this was obviously the right way to bet out of those two on this particular kind of emerging sector here. So I see Sartorius is quite nicely positioned between those two, limited upside versus limited downside, and a specific highly thought through bet on somebody's pipeline.
Yeah, I was going to say that this is one where you start getting towards my circle and you're getting like a little bit too far out of it for me. It's not an area that I would back myself in, to be honest with you. But yeah, I can see what you were looking at. I was just thinking, first off, my first thought was, yeah, that doesn't sound very American company, this, but then you did explain it there. But I can see when what you're looking at here, there's definitely some sort of rebound forecasting some of those estimates in 2025, 2026. You might have said it there, but I think I was just writing something down. What was the big cause of the fall off in the last year, 2 years, Steve? What was the big impact there?
Basically, overstocking at their customers. So customers were expecting to be producing things like vaccines for a number of years, so they bought way in advance of what they thought they would need, and basically were sat with product on shelves that they were no longer using at any great speed. I think the vaccine essentially, as you can see in somebody like Pfizer's earnings, it didn't gradually dissipate. It dropped off a cliff, and because of that, shelves were stacked essentially with Sartorius products, and that just limited the demand whilst they got through this customer backlog. It's taken them the best part of 18 months to get through this backlog, and the reason that the share price has gone down so much is because they've had to continually disappoint. So because the vaccine demand has been so difficult for them to predict, they've been saying like, look, in a quarter or two they'll be through this backlog. Actually, in 3 quarters they'll be through. Actually, it's going to be 4 quarters, and they've got to the point now where they've gone, actually, in 6 quarters, they will get through this backlog of our products, and we'll start getting to a point where we can start growing again. And we're actually at that point now as well. They've actually turned around and said, look, we're no longer forecasting, revenue growth of not very much or negative. They're actually forecasting around 10% growth in revenue, which shows that there's still an element of destocking in next. It was going a lot quicker than that in the past. An element of destocking still to happen, but growth is returning to Sartorius, and that's probably why you're seeing the uptick in the analyst scorecards.
It reminds me a little bit of Pfizer. I've had a lot of people keep messaging me, have a look at Pfizer and look at how low that is. And, they've had a bit of a tough time. They're not the top of the kind of healthcare stocks anymore. Is there an opportunity here? Eventually they'll bounce back with some of the pipeline. And every so often I keep thinking, this is probably one that I need to have a look at. And I start looking at it and I go, I know nothing what a lot of this is saying. I think this is way too out of my circle, but I think if you've got the confidence there in that sort of sector, I think there's certainly money to be made in if you make the right investment. One that I missed out on back in 2018, 2019 was AbbVie. They were having an issue where I think they lost some of the patents that came up, and they're like, oh, they're not going to get the pipeline back. And then very quickly we were able to get a good pipeline back, and the sales bounced back, and the stock has performed absolutely amazing.
Steve and I probably cut our teeth on Bristol Myers Squibb. That was the first company that we looked at together and made really decent money on it, because we could see that, look, they had this huge pipeline that they acquired through buying a couple of companies, and there was this huge pipeline of drugs that were sailing through the various stages to getting to stage 3. Now, it was very difficult for us to understand, what, if any, of these drugs would make it through, but there was just the chance that some of them would make it through, and that thesis is apparent in Pfizer as we speak now. So they've just bought, I think it's Seattle Genetics is the company they bought a couple of years ago. Seagen was a company that had a huge pipeline of cancer drugs, and it just so happens that Pfizer's range of cancer drugs has just started to drop out of patent, and they now have this huge new pipeline of things that are going through. But also they have a GLP-1 as well, which is a pretty exciting times for Pfizer. So they've lost this huge amount of COVID vaccine demand, which they're quite smartly now grouping together with a flu vaccine. So when you go for your flu vaccine, you're going to get a double shot in your shot, which allows them to charge a little bit more for the flu vaccine, plus start to destock this COVID vaccine. Plus, that's helpful for the top and bottom line. But then they've got this huge swathe of cancer drugs that are currently going through stages 2 and 3, and the GLP-1, which is the blockbuster drug. And that looks quite good for Pfizer. If you were to look at and group together analysts' expectations over the next 5 years, what you're going to see is a wall of earnings coming. And if they can realize that wall of earnings, then Pfizer should do quite well from here.
Yeah, Steve W, anything you want to add, or do you want to go across to my stock?
Just quickly on Pfizer for a moment in that case. If I were going to try and make a bull case for Pfizer, it wouldn't be to do with pipelines particularly. It would be along the lines of saying, think about what we've seen over the last 5 years with Pfizer. This is a company that has the ability to innovate at speed when it wants and needs to. Case in point being COVID-19. James Quincy is on their board of directors. If anyone doesn't know, he's a CEO of Coke. What he's doing on Pfizer's board, I don't really know. But he says the most impressive thing about them is their ability to pull forward innovation when they want and need to. I have no idea what's in their pipeline. I have no idea how they're going to go in phase 3 trials. It's beyond my circle of competence here. But what I would tell you is that if I were going to make you a case for thinking about this, I would say, look, this is a company that has shown fairly recently it can innovate at speed. And it's trading at quite a low multiple at the moment. And that might well look like value to you here, even if you think for the moment, I don't have a detailed view of this thing, but I've seen it's got some durability and it's got some assets that will, some strengths that will prove to be fairly long lasting here. That's the way I would sort of think about Pfizer from an investment perspective here.
Yeah, it certainly looks like it's down in. There's times where you want to be buying Pfizer, and it certainly looks like that it could potentially be one of those moments where if you are a buyer, now is the opportunity to be buying it. That leads me on to guess my one, which is AMD. Well, I'll start off by saying probably there's every so often there's sometimes some investments that you make, and one of the big reasons why is management. I think that's a big case with AMD. You got Lisa Su. Lisa Su has done a fantastic job at AMD for the last 10 years. I think she's been there, maybe even a bit longer actually. And she's been able to really scale up AMD really fast, to the point where it's basically the reason why Intel has struggled massively in the last few years. They've taken very good market share off them. Recently, though, AMD is the one that's been in a little bit of a slump at the moment. They've fallen a bit behind, especially they've fallen behind the likes of NVIDIA. I think a few people thought they would be able to match NVIDIA, and it turns out they couldn't. They were a little bit behind them, but recently, some of the new technology they're bringing out, some of the new chips have been bringing out, semiconductors have been bringing out, have actually been a lot better and are taking a bit of market share off NVIDIA. I think that AI, at first I was a little bit like, is this going to stay? Is this a short-term catalyst? I think the longer that we look at it, it is a longer-term catalyst. Companies seem to be getting some benefits from it now. I think even today, we've just seen Microsoft announce they're spending a crazy amount of money once again on AI at the moment. So AMD are kind of catching up to NVIDIA. I think NVIDIA cannot single-handedly have all this share, I would say, in a lot of this AI space. I think someone else has to come on and take the load. When you look at the growth potential for this AI space at the moment, it's pretty big when you look at the potential of the market cap growth in the next few years. Like I said, they're speeding up a little bit. They were a bit slow, but Q2, 9% revenue growth. Q3, they've gone up to 17% revenue growth now. Q4 expected to go to 22% revenue growth, and it's going to increase even more into 2025. The main part of the business, the big revenue part of the business, the data centers, up 22% in the last quarter. That's also the highest gross margin part of the company, so that's why there's a lot more falling to the bottom line right now. And historically, very cheap, 23 forward times earnings, which I think is the lowest that it's traded at on a forward PE basis. Any thoughts on AMD, guys?
I hate this sector. I hate this sector so much. I mean, you talk about circles of competence and stuff, and this is full of words that I don't understand. And all I see in front of me whenever I look at this space is companies that I thought had big unassailable leads finding themselves getting assailed. My kind of investing career began with thinking about Intel and seeing AMD as a competitor. And for the moment, if you don't have any technical knowledge, which I, by the way, don't, you look at Intel and you think about 5 times the R&D spend of AMD, miles ahead at the moment in terms of market share, significantly bigger company, has every advantage over AMD, and it got absolutely ripped by AMD. And then I see a similar thing with Nvidia. And I don't think Nvidia is Intel in the sense that I don't think they have the same culture that Intel had of attempting to pay dividends and stuff. No one accusing Nvidia of doing that, I don't think. I think they are relentless innovators, but my kind of fear here is that I find competitive advantages incredibly hard to assess, which is probably a good thing for AMD in the context that you're talking about here, Jacob. So you mentioned Nvidia's well out in front at the moment. That seems to be pretty clearly true. How long that will remain the case is, well, it might not be anybody's guess, but it's definitely me guessing at these kind of things. And I am entirely open to the idea that there might be more disruptive force from AMD. They've done it before. They innovate fiercely and relentlessly. But this feels like a level of technical that is beyond me a bit. So sounds plausible. But I feel much more comfortable analyzing other things. I feel like someone looking at a pharmaceutical pipeline when I talk about these things.
I think that's true. I think it is a difficult sort of space.
You also think this is outside really of my circle of competence, then, Steve?
Yeah, I do. Yeah, I was just thinking about how Intel is. The meme with the guy with a bike and his bike along, and he puts a stick in his own wheel and falls over. That is quite literally Intel, isn't it? They were doing so well, and then they just decided to waste it all on buybacks and dividends, and didn't realize that would mean they would fall behind so heavily. But AMD's not going to do that. They're a pretty different outfit. There's no manufacturing AMD anymore because they've spanned that. I think it was Global Foundries. They spanned that arm out of the business, so they are solely focused on design now. The manufacturing is essentially a non-existent part of their business. Lisa Su and Jensen Huang, I revealed to Steve only the other week, are actually cousins, so they'll have been around the techie table together, discussing strategy and what have you. So that was that'll be interesting to see. But look, I think AMD it's struggled at times because it's been known as sort of discount Nvidia and discount Intel. They were always playing second fiddle to CPUs and GPUs that the other two offered, and that's not actually the case anymore. They've actually come out with some pretty good products that are very competitive. They're going to be very competitive with Nvidia's Hopper product, it looks, so that should drive some data center sales, which is obviously high margin sales for them. Intel's CPUs are not doing very well at the moment. They're not scoring very well. The GPUs are not scoring very well either as well. So there is a real opportunity for AMD to continue hoovering up some market share there. The only problem I guess I would have is that 20% growth is like a sneeze for NVIDIA. It's pretty much what their West performing arms are doing at the moment. So there's a real chance that NVIDIA can just really run away with this market, growing at hundreds and hundreds of percent a quarter, which is what they seem to be doing at the moment. But yeah, there's opportunity there for AMD. I didn't realize it was trading as cheap as that, and that makes it very interesting to me. It's a high quality outfit, even if it finds itself in second place to Nvidia in this market. That's no shame, because Nvidia have really grabbed this market by the horns and are really running away with it.
Yeah, I think, like I said, for me, it's one of those that it is pushing a bit out of the circle. But if the tech nerd in me sometimes thinks I like researching some of these chips and how competitive are they going to be, and then I think, as anything, it comes down to a risk to reward element. And I think, as Steve D was saying there, I think when you look at the risk to reward and you go 23 times earnings, it's not too bad. But I agree with you, Steve W, as well. I can understand your point of view. Is that sometimes you look at some of these chips and you're thinking, how close are they? And you hear about these new chips coming out, and then the semiconductors coming out, and you're thinking, oh, so you're going to say it's going to be in 3 months' time, and then it ends up being 5 months' time, and then they say, I think the new one that's going to come out is the MI400X, that's apparently going to be close to the Blackwell that NVIDIA produce, and it's like, well, is it? There's that element in it, like how much can you trust it? But I think if it is true, when you look at the valuation, the risk reward, I think there potentially could be that opportunity there. Moving on to the last one then, kind of our number one kind of higher conviction stock for 2025. I think we've all kind of got one each to go with. Steve W., you want to go off with this one?
Sure. FTSE 100 company for you is Rentokil, which is pest control. Basically, they've had a pretty choppy couple of years. But I think 2025 is set to be a decent one for them. And I actually quite like their longer term prospects as well. So back to 2022 for the moment, and they acquired a big US competitor called Terminix. They've had a history of acquiring other companies, and basically what they're trying to do is increase their density in areas where there's lots of pest control call outs. So effectively, the more calls you can get in a specific area, the less time you have to spend traveling between them, the lower your costs are, the higher your profit margins are. So far, so straightforward. And the US is where about 60% of the global market is. So that's where you want to be heavily concentrated. That acquisition hasn't gone terribly well because it is a big acquisition by their standards. But I think it's starting to show signs of integrating kind of reasonably well here. Towards Q4, they've had profit warnings about 3 times, I think, in 2024, certainly 2 of them towards the later end of the year. In Q4, things started to look up. They had a profit warning and then immediately a trading update that came in much more positive than the profit warning, which was sort of odd, as though they kind of sandbagged their own guidance at short range, which is a strange thing to do. But they're talking as though Q1 sort of next year they're going to start to see the effects of things like their consolidation of their kind of effectively centres for pest control and new compensation plans for their kind of technicians. So trying to bring down costs, basically enroll the 2 businesses together rather than have technicians operating on the same routes within sort of a mile of each other. They're going to try and use fewer people to cover a broader area and sort of redirect people into areas where they can focus a bit better and spend less time traveling. The thing that kind of sticks out to me, twofold here. I mean, I think the pest control market is actually fairly durable, and I don't think there's massive amounts of disruption coming in this area. So I think being a big player in this market will grow. Stuff like climate change is worrying for a number of reasons, but one reason it helps is it actually makes better breeding conditions for stuff like flying, biting, stinging insect things that lead to more pest control call outs. The big kind of comparison for this, and one reason I'm interested in this right now, is their big kind of US version of this is called Rollins. Rollins has a $24 billion market cap. It generates $3.1 billion in revenues, $496 million in free cash flow. And so that gets you to a decent kind of fairly high multiple there. Rentokil has half the market cap, a bit more in debt, which takes you to a slightly lower but not unmanageable multiple for enterprise value. But it generates over twice as much in sales and 1.5 times in free cash flow. So I think it's trading at quite a big discount. I can understand why, because they haven't operated very well all that recently, and that will weigh on your kind of multiple from the stock market. But I think at the moment this is I think there's good value here, and I was saying to Steve on our show the last time I spoke about this, wouldn't want to have bought it 2 years ago when they were busy doing this acquisition, but I'm not responsible if I buy the stock today for the last 2 years worth of performance. I'm responsible for what goes on in the future, and I think things are starting to turn around here a little bit, which makes me optimistic for 2025 and going further a bit more further going forward than that in terms of fairly sustained, fairly steady, growing thing at a decent price right now.
Yeah. Steve D., anything you want to add in?
It's a company that we both really like for obvious reasons, really. I think it's had a quite a long period of consolidation. It's had quite a tricky and sort of turbulent integration of this rather large acquisition that they've made. But I think we're coming through the other side of that now, and it's just conditions are perfect essentially for Rentokil, and it's really a case of them just being able to execute on that now. And you got to think it's not all the sexy companies that end up being market beaters. This is not a sexy company in any way, shape, or form. But it's downtrodden just enough for it to start to look really quite enticing here. and they're making all the right kind of moves, all the kind of like shareholder, shareholder peacocking moves that you need to do to have a good year. They're consolidating their teams down. They're essentially sacking people because they ended up having too many people on similar runs. So they're consolidating all these runs down, but whilst keeping the ability to sort of service demand pretty high. So Steve's right when he says that the world is getting warmer. When things are more warm and more humid, you tend to get more of the things that you want to kill, and for that you need Rentokil, and they're going to be here with pretty large presence. They're going to have vans driving on a lot of roads in America. Some of it as marketing, some of it as actually performing the action of pest control. But they've got going to have a pretty heavy presence in America now, and if there's somewhere you want to grow, it's probably America.
You know what I was going to say? This is not going to be a TAM that grows. And then while you were talking, I was actually looking quickly then, and actually the TAM on pest control in North America is still growing at rates that I was quite surprised by. Apparently, it's forecast until 2032 to grow at a CAGR of 6%. So clearly, it's still quite a growing area. Steve W, I'm just going to apologise. I don't know if I made a mistake. Did you say your US stock, or did we skip past that?
I didn't. We can say it at the end if you like, or we can just push on as we are.
Well, do you want to go for the US stock, and then we'll finish off with Steve D's, and we'll skip mine because I know we're short on time. So would you want to go with that?
Sure. Got a close affinity with something you own from the UK. Jacob, stock's called Five Below, and you probably, I would guess, a lot of your audience won't have heard of this unless they also watch our show, in which case they definitely will. But it's discount retail, effectively. Imagine a pound shop, but with a $5 cap instead of a pound. And like pound shops nowadays, it occasionally sells stuff for slightly more than that, but also sells stuff for mainly underneath that kind of thing. This stock used to be trading at a PE ratio of about 60, and I wouldn't have suggested anyone go near it at 60, and I'm not suggesting anyone go near it now because that sounds like advice, and I don't do advice, but it's now trading at a PE ratio of 20. It's not been a good year for this company, and the reason for that it's not been a good year for this stock. It's actually been fine for the company, but it should never have been priced that high anyway, in my view. But it's been a tough year for cost of living in America. You saw the result of the election. You probably saw why that election result came about. Trump had a lot of success by saying to people, look, are you feeling better or worse off than you currently are as a result of stuff like inflation? And they mostly said, worse. And if you're Five Below, a lot of your business comes from lower income households in the US, and that's where things have started to come under pressure in terms of discretionary spending. That said, this is a business with terrific unit economics, a bit like B&M in that regard. They open new stores. Those stores pay themselves back within a year or so. Unlike B&M, a couple of things are different to B&M, I guess. So number one is it doesn't have any debt, and B&M does. Number two is it trades at a higher multiple, so it's about double the price earnings multiple. And the third is it doesn't pay a dividend. It's also got fairly strong like-for-like sales growth, though, coming through across its various operations. But look, 20 times earnings is where we're at the moment. I started buying this in August when it was actually a bit lower than that, but 20 times earnings for now. They're set to increase their store count by about 12% a year or so over the next 5 years, assuming that you get similar kind of store metric returns from this, then you will start to see, I think, those earnings push on pretty well. I'm always wary of brick and mortar retail when they start hitting scale, whether that's B&M or Costco, frankly, or anybody. And when you stop opening new stores and you start relying on like-for-like sales growth, the growth rates slow down. The multiples usually come in a bit. At this stage, though, at 20 times, I think if you consider that to be roughly another 5 or so years of 12% store growth, I think earnings will be at a level where you'll be fine from this point. Their website is absolutely hideous, by the way. It is a bit like B&M in that regard. Brightly coloured, horrible stuff. But it is apparently, and Steve would know this better than me, on trend with the kids. And they specialise in being on trend in ways that I don't fully understand. It's about as close to my circle of competence, that bit, as the semiconductor stuff or the pharma things. But they do have some very, very good unit economics. And that stands out to me in an environment where I think discount retail has a durable kind of appeal. It will be cyclical, I think, but if you can catch it in a down cycle, which I think I have here, I'm expecting this to work out pretty well over the next kind of 5 or so years. Exactly what happens in the next year, I couldn't necessarily tell you. But longer term, Five Below is maybe one that people haven't thought as much about. I mean, no one wants to hear me talk about Amazon again and say the same things about Amazon that we already know. So Five Below, my US stock to have a bit of a think about. Unlike Steve's one, it is actually genuinely from the US.
The big problem, Steve, that we discovered when we looked into this was that they're getting a hell of a lot of shrink. And for people who don't really know what that term is, it's what the Americans call stuff's been nicked. People are going into these stores and are nicking stuff at a really quite heavy rate, and it's causing quite a lot of across a number of retailers in America. This is not just Five Below, but it's causing a lot of issue. To their bottom lines essentially. So they call it shrink because it's short for inventory shrinkage. It's when you can't explain why your inventory has shrunk and your revenue or your profits haven't gone up. But there's a number of issues that they've got. They had the sudden CEO departure. They had a pretty disappointing. I think it was their last quarter or the second quarter. Was quite disappointing. They were saying that there's a decline in discretionary spending from their target consumer market, and they were pointing at things like the rise of discount retailers, things like Temu and things like that were having an effect on them. But look, Steve's right when he says that the unit economics of this business are still fantastic. They can weather all of these issues quite well. And if anybody has ever used Temu, you realize fairly quickly in that you probably shouldn't be. Everything that turns up is rubbish. It's not vetted. It falls apart. Blah 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 blah. And that's not what you get with Five Below. These things are they're cheap, but they're cheerful. They'll last a little bit longer than the Temu. You'll probably feel like you got value for money out the end of it. And look, we'll see where it goes. It's a really, really good business, though. And good presentations as well. If you want to try and understand the retail sector in America, they do really, really good presentations that will help you understand exactly what you need to look at, and they'll tell you exactly how they're going. It's a no, they won't hold anything back. It's definitely worth a look.
Yeah, I like this space. It's a space that I like buying some stocks in. B&M, for an example, that's the one that I bought on the UK markets. But even the US markets, like saying there was the Five Below that has had a pretty decent, significant dip recently. I think Dollar General was one that I took a pretty decent look into if that was an opportunity to buy. And not pull the trigger on any of them, but there's definitely some opportunity that I think is there to buy some of these stocks. I think maybe one catalyst as well potentially is in 2025 that if Trump is coming in and Steve D, like you mentioned, I think maybe some of their shoppers have been going on the likes of the Chinese suppliers like Temu, for example. Tariffs. I mean, if he starts sticking some of these tariffs on some of these Chinese companies and these ones in particular, that's only going to be a benefit for some of these retailers that are in the US, I think, and that could be a major bull case for them as well.
Dollar General's been absolutely smoked in the last year. I mean, I'm not saying what you should or shouldn't do, but my suspicion is that if you don't get over the line with it at these prices, I can't see where you will. Maybe you never will, and maybe that's no bad thing. The issue with shrink is an interesting one that Steve kind of gestured towards. The real issue they have is shrink happens to everybody in the retail space, but if you're a Five Below or a Dollar General, to that point, states can't be bothered to go hunting down people nicking $10 worth of stuff. It's not worth their effort to go and do it, and that's probably a bad thing. You should want to discourage people nicking stuff. Otherwise, you won't have any shops and stuff gets more expensive. But realistically, if you're Five Below and you say, yeah, someone's stolen one of our things, how much was it? Oh, about $5. Okay, cool. We'll not go looking into that. Realistically, we haven't got the resources to do it, and we haven't got nearly the resources to do it. So the issue with shrink is one that they have to try and deal with themselves, and that involves sticking stuff behind cabinets and cutting back on automated checkouts because that's where people find it easier to nick things and so on and so forth. Interesting for retail. You two are both in the north. I'll let you figure out what you think about shrink and that sort of thing.
I think there's a few times I've seen Steve D running out of a few shops with a few people in high vis chasing him, to be fair. So I think there might be some of that going up here in the north.
I haven't run anywhere in years, so we all know that is not the truth. I'll quickly rattle through mine as well because it's I think mine's pretty well known, so I don't want to go into it in too much depth. But look, I think my top pick for the year is quite an obvious one. I think it's ASML. They're the world's biggest supplier of lithography machines. Basically, these are the super complex machines that make the chips in your phone, computer, pretty much any electronic gadget that you own. They've got a total monopoly on the high-end machines. They don't have to worry about any competition. They are the go-to when you need this thing. Demand for these machines is pretty high right now. It's expected to stay that way. Companies like Intel, TSMC, and Samsung really need these machines to make the most advanced chips. The problem is that these things are about the size of a double-decker bus. They have multi-million parts from multi-hundred suppliers. ASML can only make so many of these machines. So they've got this huge backlog of orders at the moment. It's about 36 billion euros worth. So there's two things. You've got a pretty much guaranteed sales pipeline for a year and a bit at the current run rate. But also it's difficult to realise that without them being able to crank up the manufacturing or crank up the prices. And ASML are pretty good at doing both of those things. So they're looking at a really strong year, but it's quite complicated. They've actually lowered the revenue expectations for the year. And the main reason is that customers in the DRAM segment have been a bit more cautious with the spending just because there's been an overall sort of economic slowdown in this DRAM market. But even with that, they're expected to bring in tons of money. The demand for the machines is high enough. They've got a huge backlog of orders that they need to work through. So ASML's share price took a pretty big dive last year for a couple of reasons. First, there was a general slowdown in the chip making industry. Customers were getting a bit worried about the economy for a period, so they held off on adding to this backlog, and that actually hit ASML sales pretty hard looking forward. Second, there was some issues getting the super advanced EUV machines to customers, and these delays have frustrated people, made investors a little bit nervous about the company's ability to deliver on its promises. And third, there's this ban on machines going to China as well. China was pretty good at buying up used machines and the second-rate machines and making chips on that. And that's become more difficult for ASML to ship to these kind of areas. So that's another reason why as well. Lastly, a big slowdown in the PC and end consumer market. People have been buying less computers, been buying less phones, not as much demand. Big increase in supply in the previous years beforehand as well, which drives DRAM, which is essentially a commodity. Drove DRAM prices down, which again made customers a little bit more hesitant to continue to invest in these new machines. But if you look at revenue guidance for ASML, they're telling you that revenue in 2030 will be between 44 billion and 60 billion. And they're at about 26, 28 billion, somewhere around that kind of mark now. That's pretty much in line with analyst forecasts, which are expecting in the mid-50s billion. The top end of this guide is over a double in revenue if they can achieve it. Management have said gross margins of around 60%. Operating expenses and CapEx's estimates were revised a little bit higher, but 2030 guidance remains pretty much unchanged. The reasons differ from the 2022 Investor Day. ASML is actually now more bullish on things like artificial intelligence and more cautious in sectors such as smartphones, consumer electronics, and automotive. So if you're looking at 2025 to 2030, the compound annual growth rate estimates are about 5% for smartphones, 3% for consumer electronics, and about 9% for EV and automotive. This is actually revised down. The predictions used to be 6, 9, and 14. But what's happened is essentially what you've experienced in all of your chip making earnings is that data center forecasts have been raised. They think they're going to grow at 18% now rather than 13%. So ASML is expecting the AI server market will grow to about 350 billion by 2030. So some serious growth ahead. ASML thinks it's going to be about 10 to 20% CAGR in the extreme ultraviolet lithography, which is the newest version. This is going to be advanced logic systems, about 15 to 25% CAGR on DRAM applications through 2025 to 2030. This aligns with what analysts were expecting, which was about 16%. In revenue driven by just more EUV exposure needed to create these advanced logic and these advanced memory chips, some new fabs, some higher pricing. So look, there's about 20% upside in the price here, plus dividends to be had. I think just come in the coming year, if this growth is realised. I just previously said I don't think the US can do 20% growth in its index again. So if you want it, you have to look elsewhere, and I'm looking squarely at ASML.
We've been saying on this show that there are, I don't really get basically anything really, but especially kind of semiconductor stuff. If I get my head down and I think really carefully about this company and I do a fair bit of digging and a fair bit of thinking, I can probably spell its name correctly, and therein lies my kind of limit. But here's some things I do know about it. I find it hard to build a bear case against this. Semiconductors are cyclical, and you would expect ASML to have ups and downs as it goes along. And while people point out correctly that it has virtually no meaningful competition here, and it is the only place to get the stuff it makes from machines that make or EUV machines, basically, you would still expect there to be ups and downs on this, and you want to try and pay attention to when the downs are coming, because people will be very excited in the ups and they will tell you things like semiconductors are no longer cyclical, which they absolutely are. But when they get excited, they think that's the way things are, and they will tell you things are over when they're down. We saw this year the market had a bit of a fit because they only had about a 3-year backlog rather than a 5-year backlog. And if you think that the things won't pick up by the time that clears, I disagree, although you shouldn't necessarily take my word on anything in this area. ASML is a massive moat. The only question about it, to my mind, has ever been price. Basically, it's been at times priced like something that has a massive moat in a really important space in AI and so on and so forth. Steve set out for you some fairly neat growth numbers in that actually go quite a long way to justifying this thing at the current level, which is, I think, probably the most important thing to think about here. And it's it looks like pretty convincing stuff to my mind.
Yeah, I think it's very rare that you have a stock that you call one of those kind of hold forever stocks, or certainly hold for a very long time stocks. And I think ASML might be one of those. I think, Steve, I think you've done that for quite a few years now. I think ever since I've heard you talk about stocks, I think it's been one of those stocks that you've had in your portfolio for a long time. I think you bought pretty much every dip when it has a dip, and I certainly think it's given you the rewards when that's happened.
Yeah, there's two stocks that I've pretty much held since I swapped from fund investing to stock picking, and that's ASML and Adyen. They're two companies that I've just really, really admired. Both Dutch companies, both fantastic outfits, and yeah, both hold forever kind of companies that there's real honesty in the investor relations there, which is what I really like. They're so honest and transparent. They spell it all out to you. They make it easy to invest in these companies and to see and plot the growth. ASML has been telling you about this huge wall of earnings for the longest time. They've been saying, look, we've got this huge backlog and this is the year we're going to get through it. And I would. I mean, they've had a pretty spotty couple of years. They're relatively flat over the last couple of years, for a company with a moat as huge as ASML is unusual. But look, they're trading in a really good place at the moment. About 280 billion market cap for probably the most important company in the world. No, not probably. It is the most important company in the world, and that's not a premium to pay for a company that has this huge growth flywheel in front of it, and is as the moat as secure as ASML's is.
Mm. Yeah, well, we'll go on to, it'd be my stock, which was going to be Evolution, but we're a bit short on time. We've said we're going to do an hour. We're already on about an hour and a half. If anybody wants any information on it, I think watching my channel probably have already seen it. If you want more information, I've done a dedicated video already on my YouTube channel. But apart from that, I want to let you guys get off because you've already given up an hour and a half of your time. I'll make sure I send you a thank you card from Card Factory to both of you. Apart from that, you guys that are watching, you can support these two by going across to the YouTube channel, PlayingFTSE. I'll make sure I link it in the description so you guys can go watch their weekly podcast. Apart from that, Steve D, Steve W, thank you once again. Maybe see you again next year.
See you again.
Yep, thanks for having us.